I'm going to catch up with him so we do.
I want to believe that we can all hear me. So, good evening and welcome to uh, Advanced Taxation class. We are on capital allowances, and today is part 4. Part 4 of capital allowances begins from here. So, this is where we are starting part 4. All right, let's look at this question here. Manufacturing Company PLC has been in business for several years. Now, the key word here is for several years. And now, this is another key word, manufacturing company, and it's a PLC. So, what do we know about capital allowances for manufacturing company? They are not restricted, not restricted. Several years business, it means there's no commencement rule, there is no cessation, and they didn't tell you anything about changing of accounting date. Now, the financial statements are made up to June 30 every year. The following acquisitions of property, plant, and equipment were effected in the year ended June 30. It shows that June 30 every year is when they make their financial statement. And now this is the year ending in June 30, 2014. And this is clearly year of assessment 2015. If you have to look at the 3-year basis rule. Now we have, these are acquisitions. So because they are acquisitions, these were bought. I'm taking some hands. Somebody is saying today is not as loud as last class. Okay, just a moment.
Someone should verify that so that our class can continue. Okay, it is better. Thank you so much. All right, so let's go back now to our workings. Just a moment, let me move to my workings. Okay. Now we are told that this is for year of assessment 2015. We were not told directly, but we were told that this is year ended June 30, 2014. Now these were assets bought in this year. we were told that they were affected in the year. So what are we going to assume here? These items, these three items, we were not given the dates that they were bought. We were not given the dates that they were bought. Okay? So what happened here is, because we were not given the dates they were bought, we will assume that we are bought in the beginning of the year of assessment, so that we will take full annual allowance on them. So I will make one assumption here. But on July 1, 2013. So I'm saying this is assumed, because we are not given the dates these were bought. Now, the following disposals were made during the same year. Motor vehicle acquired for 1,500,000 in year ended this 2012 was sold for 2 million. The residues of qualifying expenditure as at July 1, 2013 were as follows. So these were the residues. So what it means here is, as at the beginning of the year of assessment, this is the tax written down values, which is also the residues, what is remaining of the asset as at the beginning of the year. And we are told that this is the useful life remaining. Then we are told that this one was sold. We were not given the date it was sold. We are only given the date it was bought. So they said it was sold in the same year, so it was assumed to be sold sold on June 30, 2014. On the last day of the basis period, that is when we are assuming that this one was sold. We're assuming that these ones were bought on the first day of the basis period, so that we can claim full capital allowance. This one sold on the last day, so that we can also claim full capital allowance before we start thinking about balancing allowance and balancing charge. So what are we asked to do here? We are asked to compute the capital allowances for the relevant assessment years. Relevant assessment years. So this is manufacturing company PLC. So I will use a different color pen here. This. Say part 4. Right? We are told that this company's name is Manufacturing Company PLC. Computation of capital allowances for Years of assessments. We don't know the years of assessment we're going to use, so we're going to leave it blank. Then we'll come back to it. All right, so what do we do now? We'll look at this year ended is 2014. And so this is 2015, year of assessment. So it means year of assessment 2015 is relevant. And they said these were the residues. Tax written down value as at the beginning of that year of assessment, 2015, which started from July 1, 2013, and ending in June 30th, 2014. So what we know now is year of assessment 2015 to we don't know. So the first thing we'll do now is we're asked to find capital allowances, right? So this is year of assessment. This is basis period. And okay, no, let me not write basis period here. The moment I put the year of assessment, I'm going to put the basis period on top of it. So let me just say year of assessment stroke BP. And I'll leave a space here. And I'll put my Naira sign and Naira sign. So the first one is year of assessment. What am I writing? 2015. 2015 year of assessment would have started from July 1, 2013 to 30th June 2014. So this is the year of assessment we are looking at now. All right, so what do? We were told that we have there's something I should have done. There are 3 assets here: industrial buildings, plants and machineries, motor vehicle. And we are still seeing them: industrial building, plants and machinery, motor vehicles. So I'm going to adjust these things here now. Okay, I will leave this as it is. I'm going to adjust certain things here. We have industrial building, plants and machinery, motor vehicles. So I'll come here. Industrial building, plants and machinery, motor vehicle, capital allowance. Okay, so industrial building, the rate here is 15%. That is for, I'll need to clean this. This is annual allowance rate. Annual allowance, sorry, initial allowance, right? Initial allowance. Or let me start with investment allowance, because I can see plants and machinery. So I'll start with investment allowance. investment allowance rate. This is dash. This is 10%. And this is dash. And this is initial allowance rate. This is 15%. This is 50%. And this is 50%. Annual allowance rate. This is 10%. This is 25%. And this 5%. You can come ahead here and write useful life. Useful life. Make it as N. So if this is 10%, so this is in years. If this is 10,
Excuse me, sir.
Sorry?
So there's a question on the chat. Please, can you check it so you can give us an answer?
I didn't see the question on chat, so sorry.
Okay.
Thank you for calling my attention. Someone say, I thought investment allowance is no longer applicable. That is for 2024, or can I say 2024 year of assessment. But what we are dealing now is 2014. So at that year of assessment, there is investment allowance. So you need to be looking at the dates and know what even happens. And when we're even talking about 2014, assuming that we are using, we are asked to find the tax liability, we'll be using the old tax regime. The date is important. The year is important when you are doing taxation, so that you will know. Okay, Mercy, your hand is still up.
Yes, sir. Thank you. So it's just on the back of what you just said. If that is the case, does that
I
also
hear
mean
you
that
well.
we
Can you
are...
speak up a little?
Can you hear me now? Is it better?
No, I have to carry the ear. I will put my laptop in my ear to hear you
Okay,
now.
hold on.
Talk.
Okay, so I'm saying that on the back of what you just said, does that now mean that when we're trying to get the basis period for this capital allowance competition in this case, do we now have to apply the old rule too, since it's 2014, 2015 year of assessment?
I still don't get what your question means.
Okay, hold on. Let me disconnect my Bluetooth.
When you
Give
are
me a
saying
minute.
basis period, when we say basis period and year of assessment, we normally apply the preceding year basis. Now, the issue we will have when we are dealing with the old regime is if we are doing commencement rule, because commencement rule has there's a difference from the old regime with the new one. If you are doing cessation rule, it's also different. In this question, we are not doing commencement, neither are we doing cessation. And so what we are doing is still the same as the new rule. This thing we are going to do now, it didn't change anything from the old to the new. So you have no fear. But the thing that when you mentioned that investment allowance is no longer applicable, that one is when you are looking at dates. When it became, when it was removed, was in 2014. And if you are doing 2020, if you are doing, sorry, it's 2024 rather. So if you are doing 2014, when it was still applicable, you will use it. That is the point I'm making. But as for the looking at basis period, everything is preceding year basis. As long as it is not as long as it is not commencement and cessation rule. So if it were to be that, I would have shown you what to do for the old rule. We'll take each question the way it is being given. All right, so let's go to what we are solving. So useful years, we know our useful years is 100. We say 100 over 10. That will give us 10 years. 10 years. 100 over 25. This will give us 4 years. And the same thing here, 4 years. So these are your preliminary things that you are doing. Then this will now begin. This is a Naira sign. Naira sign. All right, so we will now start our work in earnest. The first thing we will do is to look for the year of assessment. Let me use a different pen now. Year of assessment 2015. I can go ahead here and say it is from July 1, 2013 to 30th June 2014. Okay, so that's it. The first thing you are going to enter here is the tax written down values. What are the tax written down values? According to these questions, they said the residues of qualifying expenditure as at July 1, 2013 are these. So we are going to take them. Industrial building is 10 million. So this is going to be 10 million. The next one, plant and machinery, 2 million. This is going to be 2 million. And motor vehicles, 3 million. All right, so after getting your tax written down value, the next thing to do is to bring the cost of the assets that were purchased. Cost of qualifying capital expenditure purchased. All right. We were told that the plant and equipment were, the following acquisitions of property, plant, and equipment were affected in the year. So these were the purchases. Industrial buildings is 5 million. So this is 5 million. The next one is plant and machinery, 1.75 billion. And motor vehicle, this is 3,500,000. All right. Now that is done, the first thing to do is to look for your investment allowance. Investment allowance on plants and machinery is simply 10% of how much it was bought. Now, not on tax written down value, because this is not the year it was bought. It has been carried down. It is on the assets bought and used for that year. So this 1,750,000 is the value of plant and machinery that was bought. So this is 1,750,000. So this is going to give you 175,000. Now watch, I'm not going to put it here. Neither will I put it here, especially I'm not going to put it here. I'm going to put it here. 175,000. Now somebody asked me, why am I putting it here and it's not in here? This is because investment allowance does not affect the tax written down value. It doesn't affect the cost. It is just an additional capital allowance that is given to the taxpayer. It doesn't reduce in any way the value of the asset. So it doesn't appear under this. As if that is not enough, we are going on initial allowance. Initial allowance. Initial allowance is on the assets that were purchased in that year. So if you look at it here, this is 15% on 5 million. That is what I'm going to do now. 15%, so this is 15 divided by 100. That's of 15% times 5 million. That gives me 750. So 750. So this is 750. So I'll put it in parentheses. Sorry. This is going to be 750. So I'm putting it in parentheses because initial allowance will affect the tax written down value. Now, what about that of plant and machineries? The others are 50%. So 50% of 1,750,000. Let's look at it. So 0.5 is 50% of 1,750,000. That will give you 875. $875. All right, the next one is 50% of 3,500,000. That would be 1,750,000. So 1,750,000 is our capital allowance here. 1,750,000. That's our initial allowance. So what we'll do now, we will add all these initial allowances and our answers will be in positive. So 1,750,000 is already there, plus 875,000 plus 750,000. That will give you 3,375,000. 3,375,000. So this is 3,375,000. I think I need to put something here to demarcate that these are where I'm calculating my capital allowances. Then you will need to look for annual allowance. annual allowance. Okay, let me write it clearly for this first year. From the subsequent year, we'll put in abbreviation, annual allowance. All right. Now, we know that there are some items that we have brought in from last year down to this year. We have, for this one is 10 million. And when we say 10 million, we were told that it has 5 more years. So look what I'm going to do now. I will say before year of assessment 2015. So before that one, I will do workings. Let me say this is workings 1. I'm going to shift it down. I will leave 2 spaces and I'll do my workings here. I will say workings. Let me use a different color for workings. So this is workings. We'll say 1, annual allowance before year of assessment 2015. And so I'll start with industrial building. I'll say this is A, industrial building. Right. We have tax written down value of how much? 10 million. Then we have remaining lifespan. How many years more? 5 more years. So it's simply divide by 5. So therefore, annual allowance is going to be 2 million. So this 2 million is what we are going to use here So 2 million. So it's going to be 2 million. Okay. We will do the next one. Go down again and do the B part. B, we are told plant and machineries, 2 years more. So we say plant and machinery. We have our tax written down value. How much was that? 2 million. Remaining life. We are told is 2 years. We use years here. Therefore, annual allowance will be 1 million. You divide. So I'll go down here. I will make my 1 million here. Right. And the next one will be plants and motor vehicle. So the next one, C, will be motor, sorry, this is not clear. We choose a different color. So this is C, motor vehicle. Tax written down value, if I remember clearly, is 3 million. Remaining life, we are told 2 years more. So that's 2 years. So that means annual allowance should be 1.5. Still should write well. 1.5. Now, when you do that, take it up and you slot it in. So that's 1.5. So you add 2 million plus 1 million, 3 million plus 1.5, that is 4.5 million. So this is 4.5 million here in the bag. All right, so you've done that. Then you will say, year of assessment 2015. Now, how do we calculate for the annual allowance for year of assessment 2015? What we'll do here is we'll look at the cost of the assets.
Sorry, Mr. Chima, I didn't want to interrupt you, but I'm not sure you've seen my question in the
The voice
comments.
is very low, sorry, and there is generator making noise. So can you speak up more? Let me hear you.
Is it better?
It's
Can you hear
better
me?
now.
Okay. So sir, maybe you should go up to the second part of the question. Maybe that's what is confusing me
Second part
because
of the
I
question.
was, yes, the lower part of the question, because I was assuming that if we had those expenditures, or rather those
I didn't get
items.
your question. So where is
Can
the
you hear
second
me?
part of the question you're talking about here?
Okay, so
And
I
then
want
say,
to know, yes. So the reason why I wanted you to go back is I wanted to see the year that we are carrying those items for, because I'd assumed that they were coming from 2013, and if they were coming for 2013,
voice is still low. I'm not getting you. Um,
okay, I
you
don't
want
even know
to
what else
understand
to say.
why we are carrying this thing in 2025, right?
No, that's not it. Can you hear me? Is it better?
No, it's not better, but I put my phone on the laptop on my ear to hear you.
Okay, hold on. So I've disconnected my
Good. I
earpods.
can
Can
hear
you
you
hear me better?
clearly. Better.
Okay. So I'm saying that I wanted to see the year we were carrying these items for. That's for the tax written down value that we brought in from the previous year. And the reason is because when we were dividing by the number of years, ideally, when we did that assessment, or those the assessment we did, we said it was 10 years because we did 100 divided by 10. So I'd assumed that it was going to reduce the number of years by 1, which should have been 9 years. But I'm seeing that you were dividing for the one for initial industrial building, you divided it by 5 years. And then the
Okay.
one
So
for plant.
I guess where your question is. There is a little knowledge gap that is I experienced. I can understand here. Now, that's 10 years, 9 years, like that.
Mm.
It is from when we are starting from the beginning. Okay? These ones here have been in existence before now. As at July 1, 2013, we have 5 years more. We have 5 years more. So that means 5 years has passed since these assets were in use. So that reduction from 10 to 9 to 8 to 7 to 6 has been done before now. And now we are at the beginning of this year, and it has 5 years to go. And we are dividing this by 5 to get the
Okay.
capital allowance. Now this one is having 2 years to go. This one is having 1 year, 2 years to go, as at the beginning of our basis period in question.
Okay.
So that's why we are dividing them to get the capital allowance. Remember, I told you that capital allowances is straight line. It behaves like straight line depreciation, although it is not depreciation, it's given in lieu of depreciation. It behaves straight line. So if they tell you 5 years more, you have to divide by 5 to know what the annual rate is. Otherwise, they would have told you the annual depreciation. They didn't tell you, they told you the number of years more. So the technique to get the annual depreciation is to divide by the years given to you, which we did here, and that's how we got.
Yeah, I get it now.
Okay, so you're getting it now. Now, after dealing with the ones that we are bought, that we are carrying down, all these ones that we are carrying down, we are now dealing with these ones that we are purchased. And now we said, because they were purchased in this year, the annual allowance, okay, now let's do another workings for this. I'll say this is workings 2. So workings number 2, annual allowance for year of assessment 2015. Okay, the A part is industrial building. We have the costs of assets. The cost here, we are told, is 5 million. Less initial allowance. Initial allowance, the initial allowance, that's 15%. Like we are told. How much did we calculate the other time when we did initial allowance? We calculate 15% to be what? To be 750. The cost is 5 billion. 15% is 750. Okay, so that is 750. Now, when we remove it from 500, so 5 million rather, minus 750,000, that will give you 4,250,000. So 4,250,000, 4,250,000. Now, the number of years of useful life is going to be 10 years. So this is like to do the annual allowance. So annual allowance will be 4,250 divided by 10. That will give us 425,000. So this 425,000 is what is to be taken. And we're not prorating because we have assumed from this thing here that it was bought on July 1. We were not given the date it was bought. So we assume it was bought at the beginning so that we will not prorate. So we're doing 425,000. So 425 is what is going here. So this is 425,000. All right. We'll do the next one, which is plant and machinery. So we'll say B, plants and machinery. Okay. We have the costs. The cost should be 1.75 million. 1,750,000. Initial allowance, we are told is 50%, and we calculate that to be 875. If I can remember, let's see. $875. Okay. So we'll take that. 875. Then when we less it, it will give us 875. Then number of useful years. We say it's 4 years. Just a moment. Number of useful years, we say it's 4 years. Okay. Sorry, there's a sound coming from my phone. I want to remove that sound. It's distracting me. Getting a WhatsApp group call. Just a moment. Okay, so I've sorted that out. Number of years is 4 years. Okay, 4 years. And when you divide it by 4, let's do it together. 875,000 divided by 4, that will give you 218,750. 218,750. 218,750. Now that's your annual allowance you'll be taking. 218,750. $218,750. Okay. And the last one here which is the C part, is motor vehicle. Motor vehicle, the cost is 3,500,000. So the costs 3,500,000. Initial allowance, which is 50%, I think we remember is 1,750,000. So let's just verify. 3,500,000 times 0.5, that's 1,750,000. So since this is 50%, when we less 1,750,000 from this, we are going to be getting the same 1,750,000 as our residual. Then the number of useful life is 4 years. So we divide by 4, 1,750 divided by 4, 437,500. 437,500. 437,500. So when you do that, 437,500, take it up. 437,500. 437,500. All right, so let's add them up. We have 437,500 already with us. Then we'll plus 218,750. Then we'll add our 425,000. That will give us 1,081,250. 1,081,250. 1,081,250. Okay, now that's not all. We were told that the following disposals were made in the same year. The following disposals were made in the same year. Vehicle acquired for 1,500,000 in the year was sold for 2 million. So let's look at disposals. So we'll now say now what's happening here, if you look at the cost of the assets and look at the tax written down value that was brought. It is the tax written down value that was brought for the motor vehicle that we are now after. The vehicle that was sold, the value of that vehicle, the cost value of that vehicle was inside this 2 million. We want to know how much cost value it had here and how much depreciation had affected it. And let us see how much depreciation that was inside of this here that was inside of these, because we have to take it out. Because we are taking this cost, we are taking the cost of that vehicle here. We are also going to take out the depreciation so that we'll see what is the tax written down value, which will make it qualify for either balancing charge or balancing allowance. So we're going to go to another workings. Sorry. Number 3, disposals in the year. Okay, we'll read that question again. They said, the following disposal were made in the same year. Motor vehicle acquired for 1.5 million in the year ended. So we'll now look at costs of motor vehicle disposed. So the cost of motor vehicle disposed is how much? 1.5 million. Okay, so this is what it cost us to buy that vehicle. When was it bought? It was bought in the year ended June 30, 2012. So it means that the year of assessment for this year should be 2013. And we are dealing in 2015, meaning it was bought 2 years ago. All right? And when we say 2 years more, it means it was part of the asset that was bought 2 years ago, in which we have calculated depreciation on it now. So, bought in year of assessment 2013, 2 years ago. And we remember that motor vehicle, the depreciation is 437,500. Okay, sorry, not depreciation. Capital allowance claimed is 437,500. 437,500 multiplied by how many now? Now, hold on, hold on. This asset was bought 2 years ago. So it means in 2013, we claimed this 437,500 in 2013. We also claimed 437,500 in 2014. And now we are assuming that these disposals were done at the end of the year. So it means that in the same 2015, we have already claimed 437,500. So we have claimed capital allowance for 3 years. 3 years. So let's do the calculation now. 437,500 multiplied by 3 years. So this is the total capital allowances that have been claimed from the day it was bought to the day it was disposed. 312,500. 1,312,500. So we're going to write it down. So this is the capital allowance claimed. And so this is your tax written down value. So what happened here? We are going to minus this. Okay, let's do it this way. We are minus, sorry. So let's do it the normal way now. Since this thing doesn't want us to. All right. 1,500,000 minus 1,312,500. So your tax written down value should be 187,500. 187,500. 187,500. So this should be 187,500. Okay. All right. So this is your tax written down value. Then we have, what's wrong with my mouse now? We have cash proceeds from disposal. We are told we sold it for 2 million. So it means that we are having a balancing charge, not allowance, because the money you got is much more than how much you disposed it. So your balancing charge, not allowance, is simply 2 million. Sorry, 2 million, take away this, will give you 1,812,500. 1,812,500. So that's your balancing charge. What's happening to me? 1,812,500. 1,812,500. This is your balancing charge. Assuming we are looking for profits or tax, this should have increased your assessable profits. So there is no balancing allowance. So what happens? What's our story? Now, this 15 million costs. This 15 million costs. Okay, so this is the cost of the assets that was disposed. As at this time, this 187,500 is the tax written down value of that asset that was disposed. So we are going to remove this figure from our calculation. So this is the tax written down value on assets disposed. So this is the value as at the end of the year. And because we have sold the assets, we have to remove this figure. So when I say disposal, so I will just simply come here and say, sorry, simply come here and say less disposal is working 3, nothing here. How much did we get that time? This is nothing here. Let's go and look at that figure. 187,500, right? 187,500. That is the asset disposed. So we are removing it because it has been disposed. $187,500. Okay, so the capital allowance on this asset disposed is inside of these. It has to be claimed because it was disposed at the end of the year. So we would have claimed the whole asset before it was disposed. So otherwise we would have adjusted it. So what will happen now is we will now say total capital allowance. So the total capital allowance, the sum total here. So let's do it together. I have 750,000. Sorry, 175,000, which is your initial allowance cumulatively, plus 3,375,000, which is your annual allowance, the first one we calculated, plus 4,500,000, the second annual allowance we calculated, oh, sorry, the 175,000 is the investment allowance we calculated. This 3,750,000, the initial allowance we calculated first. Then this 4,500,000 is the first annual allowance we calculated. Then we have 1,081,250 as the annual allowance of the second time. We have 9,131,250. 9,131,250. So let's record that. We need to take this up. $9,131,250. And so this is your annual allowance for that year. So the next thing to do here is to go to year of assessment 2016. And of course, it's going to give me from July 1, 2014 to 30th June 2015. Then I will start with tax written down value. So what's the tax written down value? We will start all the way down and do them one by one. Initially, we have 10 million naira from the previous year. Added 5 million to it, which is the cost. Initial allowance 50,000. We now less annual allowance, first one of 2 million. We then less 425,000. Sorry. And this becomes our annual tax written down value. 11,825. 11,825. So let's take it down here. So this is 11,825,000. All right. Then we'll do the same thing for the next one. We have 2 million here. We now added 1,750,000. Then we're taking away 8,000. And again, we are taking away 1 million. Then we're taking away 218,750. 218,750. What else again are we taking? Let's see if we're taking another thing. Okay, nothing else is being taken away. So what's our final value? Final value is 1,656,250. One, 656,250. All right, so let's do the last one. So we have here we have 3 million. Then we added 3.5 million. Then we took away 1,750,000. Then we took away 1,500,000. Took away 437,500. Then we took away 187,500 to give us 2,625,000. 2,625,000. 2,625,000. Now I want to draw these ones down because the capital allowance will also go here. So let me take this down again. All right. Since there is no asset bought, we'll only do annual allowance. Annual allowance. So we'll start before year 2015. Before year 2015, we used to
Mr.
take...
Chima.
Yes, please.
I have one question on this motor vehicle. You know, we have 3 million. And out of that 3 million, they said they dispose. After the calculation, we got 375 as the disposal of assets. So I thought we were supposed to remove the 375 from that 3 million.
Come in my system. Just hold on. Something happened to my system. Okay. All right. Say it again.
I said this 3 million under motor vehicle. I thought we supposed to remove this 375 disposal from it before we calculate our capital allowance.
We are supposed to remove this 3.5 million from
375,000.
I didn't get that. We're supposed to remove what?
375,000 from this 3 million.
Where is the 375,000 coming from?
Is a disposal.
There's no disposal of 375 million. I have 187,500.
You know, 2014, once we calculate our annual allowance, after the calculation of annual allowance that we remove from the
Okay,
cost.
so can you allow me to repeat motor vehicle again?
Okay, repeat it.
All right. This is the tax written down value from before 2015 year of assessment. It was 3 million.
Okay.
We now bought a new asset of 3.5 million. Okay. Investment allowance did not affect it, so let's leave that. Initial allowance is on this asset that was bought. This one bought, we got our initial allowance, which gave us this. Annual allowance. Now, when we say before 2015, we are referring to this figure. It is from there we got our annual allowance. Then when we are referring to the year 2015, we are talking about this figure. It is from there we got this. And when we say disposal, part of this figure, the asset Okay, can somebody say something to know whether I've been heard? I've been saying some things for some time. I don't know if we heard me. If you didn't hear me, please. Hello? If I don't get a response, it means nobody's hearing me. Okay, somebody say I didn't hear. Okay, I was having issues with my audio. So let me explain again. All right. Let me explain again. I was saying that this 3 million was tax written down value before the current year of assessment. The current year, we bought 3.5 million. Then we do initial allowance on this 3.5 million, which happens to be this 1,750,000. Then we have annual allowance. The first one was carried out on this, which is this 1.5 million. The second one was carried out on this one that was bought in this year, which is 437,500. Then part of this was disposed, was sold off. So the part that was disposed has been calculated to be this. So this is a cost. That's why we didn't put it as capital allowance. This is a cost. So this one here is reducing this amount, technically speaking. I don't know if you understand my explanation.
I can't see your screen.
Huh?
I did not see your screen. I don't know this one you were touching. So it's not showing. Just show the
Let
table.
me
Okay.
stop my screen and share again. Sorry about this. Please confirm that you can see my screen.
I can see it.
Can you see my screen now?
Yes, I can see it.
All right. So this first 3 million was brought into the year. So it's previous accumulation, tax written down value. Then this was the actual items we bought for the year, the cost of what we bought for the year. Then we calculated initial allowance on these items that we have bought for the year. Then when we calculated our first annual allowance, it was based on this one that was brought before. When we calculated the second annual allowance, it was based on these ones that were bought in the year. Then we were told that some asset that was bought in a previous year before now, which is included in this 3 million, was sold. So we calculated the value of how much the car would have been, the cost of the car would have been as at when we are selling it. And this is it. And because we have sold it, this is the cost item of the car we have sold. Although we sold it for 3 million. But what is the cost as at the date we were selling it? The cost of that item as at the date we are selling it was 187,500. So it's going to be reducing this 3 million because the asset is no longer available. So I don't know if you understand what I just said.
Yes, I understood. So now, that 1,500, this
This one,
1,500,000, we will
yes.
remove the initial allowance, which is 750. Then we remove the annual allowance, which is 187,500.
Annual
Then
allowance is 187. I don't understand. This 187,500 is not allowance. It is disposal of. So what we just did is all these ones that are positive, we added them. This is an allowance, we remove. This is an allowance, we remove. This is an allowance, we remove. This is disposal, we remove. Because addition, we added.
this
Disposal.
187,500, is it the disposal? Because in my own calculation here, annual allowance is 1,500 minus initial allowance divided by 4. It's giving me 187,500 here.
Wait. Initial allowance is 1,750. Can you see it here? Look at the line, 1,750. So let's do it again. I calculated annual allowance here. If you can see how I calculated it. Motor vehicle, the cost is 3,500,000. Initial allowance is 50% of this, is 1,750,000. When we remove 1,750,000 from 3,500,000, we got 1,750,000. And this asset has 4 years to go. We divided by 4 years and we got 437,500. That is how we got our 437,500 annual allowance. That's how we got this annual allowance. This 1.5 is initial, is not related to this. This 1,500,000 is annual allowance relating to this. We were told that this asset has 2 years to go, and we divided it by 2 And we got for each year, it is 1,500,000.
Okay.
That was how we got this. All right, we've gotten our assets here. Now, tax written down value, we've gotten all of these from simple calculation. Now, annual allowance before 2015. Now you can see here that the plant and machinery, sorry, the motor building, you know, the first time it had it had how many years now? Let's go up again. It had 5 years. Now in this year, it's going to be 4 years, right? We are still going to take our 2 million. We are still going to take our 2 million. So here, annual allowance here will still be 2 million. Okay. Sorry. Now, when it comes to these two items, plant and machinery and motor vehicle, we're taking 1 million. As at 2015, it was 2 years remaining. In 2016, this is the final year. This is the final year. So what do? We'll take this 1 million, but we'll leave a residue of 10 naira. So we're going to take 9 million, but in some books, they will just take the whole thing because we still have some values up there. But that's not the way. Because this asset is going out. 1 year is remaining, and that's the year that is remaining. We're going to take 1 million minus 10 naira. So what is going to be here is going to be 1 million minus 10 naira. That's going to give me 999,990. So this is going to give me 999,990. Okay. Now, for this asset, motor vehicle, now because it is 1 year remaining, we usually take, okay, sorry. This is 1 year remaining for the motor vehicle. One year remaining for the motor vehicle. So if you look at it now, we're supposed to take 1,500,000. We're supposed to take 1.5 million, right? Now, if we take 1.5 million, it means that is the annual allowance for all the vehicles, inclusive of that one that was disposed. Somebody's asking a question again. Someone said, I can't see your screen. I will need to stop and share again. So let's confirm that we can see my screen now. Yes, participants can see my screen. Now, this is the annual allowance that we are taking, inclusive of that asset that was disposed. But you see now, The asset that was disposed. The asset that was disposed, we claimed, just a moment. Just a moment. We did something wrong here, which I will correct now. Capital allowance claimed for that asset disposed. I'm revisiting this now. So this was bought 2 years ago. And this is the way we would have done it. This is the way we would have done it. I beg your pardon. I should have done it well. So this was the asset that was disposed. It was bought 2 years ago. We would have claimed initial allowance first on it. Initial allowance would have been claimed, which is, initial allowance would have been 750,000. Annual allowance would have been 1.5 million minus 750 divided by 4 years, multiplied by the number of years we've claimed the assets. We've claimed the asset for 3 years.
Yeah.
Okay, so let's look at it again. 1.5 million is the cost of the asset minus 750,000, which is the initial allowance, to give you 750. If you divide it by 4 years, this is the number of 1 year figure multiplied by 3 years that was claimed, 562,500. So this will be, this will be 562,500. What I will now do is 562,500, which is the annual allowance, plus 750,000, which is the initial allowance, should have given me 1,312,500. 1,312,500. Then, when we less it here, so let's less it from 1,500,000. That will give me 187. All right. So when we minus this from this, we get 187,500. So it's still the same thing here. 187,500 was the tax written down value. So it's still the same thing. The way I calculated it the first time, I decided to use this and multiply by 3, but I thought it wise that the best way is to do all the assets for it separately, initial allowance on it, annual allowance on it separately, adding them up, and it gives me this. So we are still on course. All right, so when we come to motor vehicle, Okay, when we come to motor vehicle, annual allowance that we are supposed to take for that year, annual allowance we're supposed to take for motor vehicle for the year before is supposed to be, where is it again? 1.5 million. But look at what we will take.
1312.
We have 1,500,000, right? This is what we are going to take, assuming that asset was not disposed.
Yes.
Minus how much are we going to take now since the asset has been disposed? Okay, let me
Minus
do some
187 from
here. It's not going to be 187,000 again
no.
because we have less than 187,000. I would have done something here. Let's do this. 1.5 million
1,312,000
minus 750 divided by 4. 187,500 for 1 year. All right, that's what we have taken. 187,500 is what we would have taken. So we'll do it now. 1,500,000, which is a normal thing. We're going to remove this asset we have sold, the depreciation that would have entered this, 187,500. So it is going to be 1,312,500.
312. That's what I was
Good.
trying to
So
do.
1,312,500. 1,312,500. Now, take a note now. It is the last year. It is the last year. So 1,312,500. We are still going to remove 10 naira. So it's going to be 1,312,490. 1,312,490. But that's the last year. 1,312,490. So last day. Then we'll look at bought in year of assessment 2015. So how do we do that? We simply do what we have been doing before. This one is going to be 425,000. In fact, I will take it from up here, 425,000, instead of going down. 425,000. The next one will be 218,750. 218,750. And the next one will be 437,500. 437,500. All right. So what do we do now? Let's calculate our capital allowances. What's happening? All right, so let's add them up. I already have this one here in my calculator. So I'll just add 999,990 and I'll add 2 million to it. 4,312,480. 4,312,480. This other one here is 1,081,250. I will attend to your question. 1,081,250. Somebody is asking a question. Could you send us this solution? Of course, I'm going to send you, because this is containing, this solution here is containing everything from part 1 down to part 4. So I'm going to send you all this solution. All right, so let's add up this. We have this already in our calculator. Then we have 1,081,250. That gives us 5,393,730. $5,393,730. Now that's your capital allowance. So that's your capital allowance. Then you will go to the next year. This is going to be 2017. We use another color. Year of assessment, 2017. Of course, it's going to be from July 1, 2015 to June 30, 2016. This will now be tax written down value. So your tax written down values will be all of these. So we have 1,825,000 minus, I'll combine all of them, 2,425,000, 2,425,000. That gives me 9,400,000. So that's $9,400,000. Then the next one will be 1,656,250 minus 999,990 minus 218,750 to give me 437,510. You see, this 10 naira is affecting it. 437,510. $437,510. Okay. Then we will now have $2,625,000 minus, let me remove this thing from my view, minus 1,312,490. What am I writing? 312,490. Then minus 437,510. 37,500. 875,010. You can remember these figures. 10 naira is affecting it. 875,10. So this is 875,010. So you will now look for capital, okay, annual allowance. So this is your, annual allowance. So you will not be saying before 2015 now, because this is bought in, what's happening? Bought in 2015. So I will just come down here and bring these figures, 425,000. Now come here, 218,750. And I'll come here again, 437,500. I'll add them up and I will still get 101. Okay, same thing here. I got 1,081,250. Now, take note. We started from how many years? 2015, that's 5 years remaining. So this is 1, 2, 3. So for the land and building, out of the 5, 3 years have gone. What ICANN is expecting you to do is to do it up to that 5 years. So we'll do 2018 and 2019 is where we'll stop. So it is going to be this year. So year of assessment 2018, basis period will be first. Okay, sorry, I didn't put capital allowance. Okay. This, okay, yeah. This suffice for capital allowance. 1st of July 2016 to 30th June 2017. So let me use another color now. Tax written down value. It will be 9,400,000 minus 425,000. Oh, I beg your pardon. Sorry. Annual allowance before 2015. Land and building is still there. Land and building is still there. Before 2015, the 2 million for the land and building will be there. This will be dash. This will be dash. So this will be 2 million. So your capital allowance will be 3,081,250. Okay, so your tax written down value now will be 9,400,000 minus minus 2 million minus 425,000. That will give you 6,975,000. 6,975,000. Okay. Then these other ones will give you 437,510. My 218,750. Okay. That will give you 218,760. I'm beginning to like this. 218,760. Then this will give you 8,7. Five 010 minus 437,500. Give you 437,510. I'm liking this. Four, 3,7,510. Okay. With that, you calculate your annual allowance. Annual allowance. We now say before 2015, of course, you have your 2 million here. There's dash, there is dash. But 2015, you have your 425,000. Now you have 218,750. See, that 10 naira must be left. Then we have 437,500. Okay, so this will still give you here 2 million. This will give us 1,081,250. Is that it? Yes. To still give you the same figure, capital allowance will give you 3,081,250. That's your capital allowance. Let me write this because it's a note you will be reading. Capital allowance. So this is your capital allowance. Then the next one should be year of assessment 2019. This is going to be July 1, 2017 to 30th June 2018. Then we have your tax written down value. Let's calculate. It's going to be 6,975,000 minus 2 million minus 425,000. That will give me 455,000. 450,000. This one will just give me 10 naira. So give me 10 naira. Then your annual allowance will be before 2015. You can decide to take the whole 2 million, or you can do it the way we did the last time by saying 1,999,999. Whichever way is fine. So I'll do it that way. No, I will take the whole 2 million. So you see that you can do it either like this or like the other way. So this is the last one for the old assets, 2 million. So everything will still be 2 million. So if I've taken 1,999,000, that means when I'm on the last year, I will still take everything as complete without leaving 10 naira because I've taken the 10 naira here. But if I take everything in the last year, I must leave 10 naira. So let me do it this way now. But 2015, you will still have your 425,000. This is dash and dash. So this is 425,000. So your capital allowance will be 2,425,000. Okay. So let's see what the tax written down value will be. Tax written down value will be 4,550,000 minus 2 million minus 425,000 to give you 2,125. 2,125,000. Okay, so what have we succeeded in doing here? Let me show you something. From 2015, I've done up to 2019. So let me go here and say to 2019. Okay, now I've succeeded in removing from 2015, how many years? 15, 16, 17, 18, 19. I've succeeded in removing all these old assets that were bought, that were brought in. I've succeeded as of 2019 in removing them. Then, as at 2019, I've also succeeded in removing these two that were bought in 2015. They were finally removed in 2018, which made them 4 years. Now, as at 2019, this one that was removed, this one that was bought here, this one that was bought, as at this 2019, 5 years has passed. So 5 years is still remaining on this. Now let's test something now. If we were to divide these things by 5 years, 420 equivalent to all of these. So as at this point here, 5 years is remaining. So it means that assuming you do 2020, 2021, 2022, 2023, it will end in 2024. Assuming no assets were bought, you are just doing it. As at 2024, instead of taking 425,000, you will take 424,990 and leaving 10 naira in it. So that's the point I want to emphasize here. So the reason why we stop here is I want to show you that we've succeeded in removing that 5 years from the old plant and building, and the new plant and building we've taken 5 years. So the old one has gone. It has lived its own full 10 years. This figure here is purely that of the new assets. 5 years is remaining. And we have tested that if we remove 425 every year for 5 years, it's going to give us this figure. Now, the reason why I did that is I didn't want to have that 10 naira left from here so that I can show you this. Because if I have taken 1,999,990, there will be a 10 naira here. And I told you that it's correct if you take it like that. So it means that in 2024, you will still be taking 425,000 as you did in other years. But because you took 2 million and you have this, in 2024, instead of taking 425, you are going to be taking 424,990. And so that's it. So this is what the examiner is expecting from you. So this is the solution to our problems. And so with this example taken, we have come to the end of capital allowances. Now, I must tell you that even though we've come to the end of capital allowances as a topic, capital allowances will always be figuring in your other questions. So we are going to be looking at other questions where we will see capital allowances being treated. And we're going to be treating some aspect of capital allowances that you were, that was not even touched here, or that was touched briefly. We're going to touch them well when we are treating pure questions that will require capital allowance. So we've come to the end of our class for today. It has been a very, very interesting class. And I'm going to send you this 18-page whiteboard that contains everything we did on capital allowances, all the examples that we solved on capital allowances. You're going to see them here. And we are going to start a new topic, which will be announced to you later. So thank you so much. Any questions should be addressed to me in the WhatsApp group. And I will see you in the next class when this new topic will be discussed. Until then, it's good night from me.